thank you very much, everyone. Chris, Paddy, for the invitation. So Paddy talked a little bit about microfinance, and so let me add a little bit of motivation from the microfinance literature. So the classic microcredit contract, which many of you would be familiar with, has many features which are theoretically appealing for mitigating adverse selection and moral hazard in informationally opaque lending markets. And Paul has already talked a little bit about adverse selection and moral hazard, so I won't go into that. But many of you would know that the microcredit contract has these distinct features, traditionally joint lending, group model, social capital being leveraged rather than physical capital. And no doubt has led to very high repayment rates for institutions, even when borrowers don't actually have much collateral. Again, many of you would be familiar with the large wave of experimental literature, which has shown zero average effect from several large-scale microcredit experiments, which is a bit of a puzzle for the finance and development literature. It's a puzzle because we have a lot of evidence which suggests that there are underlying higher returns to capital, and this comes from studies that Chris has done where they've given capital to small firms and found very high rates of return, 5 to 10% per month. Paul has also done some work in this space. And so it's a bit puzzling. If there are these high underlying rates of return, and to your point, Paddy, we believe that many people are credit constrained, why is it then when microcredit was expanded on a large scale, we saw zero average effects? Now, many of you would know that there's nuance behind that expression of zero average effects. There's a lot of heterogeneity there, and I'm going to hear a presentation today about some of that heterogeneity. But nonetheless, it is a little bit puzzling. One feature in particular of microcredit contracts is rigidity in the repayment structure. So again, Paddy mentioned that a little bit in the introduction. You often hear that rigidity is important in these settings because it instills discipline in borrowers. They turn up, you see them, they repay, they realize that they must repay, and we get very high repayment rates in microcredit compared to, say, some of the repayment rates that we've just heard about from the PEDL model. Now, this rigidity has been effective in terms of getting high repayment rates for the institutions, but you can think of lots of reasons why a very rigid repayment structure where you have to take a loan and start repaying 1 week later in front of the whole community, there could be some shaming if you don't repay, may not be the best contractual structure for incentivizing investment from the actual small businesses that have high return investments available to them, but possibly quite risky returns, and also for individuals who may be more on the risk-averse side. And so there is a literature, and one of our speakers today, Georgia, has contributed to that literature, which has shown that beginning with a very rigid microcredit contract and introducing a little bit of flexibility, specifically through a grace period, which allows people to skip payments when they need to, or at the beginning of a loan, has led to higher expected return investments. But it can also lead to higher defaults for lenders, right? So if lenders are giving contracts that lead to riskier investments for the borrowers, and some borrowers are doing well and some borrowers are not doing so well, they're only capturing the downside of those riskier investments and not capturing any of the upside. Whereas more equity-like contracts have the potential to better align incentives between the capital provider and the small business. And so I'm going to be thinking about introducing equity-like contractual innovations within the standard credit contract. And by equity-like here, I'm referring only to payments that are performance contingent. So payments that go up and down based on the underlying performance of the business, which could be beneficial for the aforementioned businesses who do have access to high expected return but risky investments and who may be risk averse. But it's very difficult to implement these kinds of contracts in many of the low and middle income settings that many of us work on due to something that academics call costly state verification. Like basically, how do you know what the profits of a very small business is? Now, we are at a point of inflection in finance in many low and middle income countries. We've heard a lot today already, and we will continue to hear the fact that for many of these small informal firms that we knew very little about in terms of having administrative data for their performance, suddenly they have digital footprints. Very small firms in India, in Brazil, and some of the work that Paul just mentioned in Mexico, suddenly have a huge amount of information for small firms, and you can actually do a lot there in terms of improving the screening process and the monitoring and repayment process. And so, I had a really good call with Jim, who's the discussant today, and look forward to hearing more from him about this. One way of just using this huge amount of data is just to continue business as usual. I've got a huge amount of data. I can just improve my screening and improve my enforcement, but keep the business as usual in terms of the products that I'm actually implementing. Or we can use it to kind of innovate in the product space. And so these developments really mitigate some of the challenges, reduce some of the challenges to providing more tailored contracts, contracts that are better suited to the businesses that we're trying to finance. And so I'm here just saying that data allows us to better tailor contracts. I'm very much looking forward to hearing from Jim and from other practitioners about exactly what is being done in this space, innovations in this space, where more work is needed from both academics and practitioners. What I do in this particular paper is think about the demand side. So I've talked a little bit about the supply side. So there's data, there's potential to better design contracts, there's a willingness from people in this room to experiment in that space. I'm thinking in this paper a little bit about the demand side. So the borrowers themselves, the small businesses themselves, what are their preferences over different contracts, more debt and more equity-like contracts? And specifically, how does it relate to their underlying risk preferences or risk aversion? So what I do is I work with 765 small business owners who are looking to grow their business, and I draw those business owners from two larger field experiments that we were implementing in Kenya and in Pakistan, where we're providing them with asset financing for larger loans. And so I use investment games, which are basically incentivized games with these business owners, to show firstly that when financed with equity-like contracts, they choose more profitable investments compared to more rigid debt contracts, which is not surprising to many people because these contracts provide implicit insurance and it leads to more profitable investment taking place. And secondly, I find that I use 30,000 incentivized choices. We're offering people incentivized choices to show that there's a very interesting role for risk aversion and risk preferences. And so I'm going to think about 3 dimensions of risk preferences, which are going to incorporate a little bit of behavioral economics. Okay, so the first one is the standard way that we think about risk aversion in economic models, which is just you've got a utility function and there's a curvature to your utility function, like some people are risk averse. And you can measure people's risk aversion by offering them, for example, lotteries where they could win 1,000 or nothing with a 50-50 probability, so it has an expected value of 500. Or you can offer them a certain payment of money to just walk away from that lottery. So if they said, I'm indifferent between that lottery that pays 1,000 or 0 with 50-50 probability or 500 for sure, then they're risk neutral. If they say, oh, actually, I'll take 375 or 300 or 350 rather than this risky lottery, then that's some measure of risk aversion. So we can do these incentivized games to measure like who's more or less risk averse. And I find that, unsurprisingly, people who are more risk averse have a preference for equity-like contracts and choose more profitable investments when financed on an equity-like contract compared to debt. The second measure of risk preference is I introduced something from behavioral economics, which many of you would be familiar with, and that's the concept of loss aversion. The work of Kahneman and Tversky, where it's been found that many people in the population are more sensitive to losses than they are to gains. So we have a reference point, and we're particularly sensitive to losing compared to gain. So it could be, the reference point could be our current level of assets, our wealth, and we're particularly sensitive to the downside relative to the upside. And often it's found that people are twice as sensitive to the downside as to the upside, and this is robust in several experiments. And so I find a similar thing here in this population. And I'm going to find that loss aversion has important implications for choice between equity and debt. If you think the intuition for an equity contract is that it's providing downside sharing, which loss-averse people particularly value, in return for upside sharing, which they're happy to do. So equity loss aversion provides an additional motivation, additional justification for why equity contract could be particularly beneficial for these small business owners. The third component that I will discuss is a little bit more nuanced, and it is probability weighting. And again, this relates to prospect theory, which is the work of Kahneman and Tversky. Probability weighting refers to the fact that people may behave as if the probabilities that they're facing are different to the actual true objective probability. So for example, you could tell someone that the probability of you earning extremely high profit is 1%, but they just behave as if it's 3% or 4%. And so in a number of studies, it has been found that a large share of the population, their behavior is characterized by what's known as an inverse S-shaped probability weighting function, which is that they overweight the small probabilities and underweight larger probabilities. Now, there's a lot of behavior in the real world that is extremely difficult to explain with a standard economic model of expected utility theory, where it's just about utility curvature. For example, many people buy lottery tickets and they buy insurance. It's impossible to reconcile that with the standard model, right? Whereas with the model that allows for probability weighting, well, people overweight small probabilities. They overweight the small probability of very large loss, and they overweight the very small probability of very large gain. And so they'll buy lottery tickets or things that look like lottery tickets, and they'll buy insurance, and they can sleep at night. And so this is a model which can capture that kind of behavior. And I'm going to find that this feature, which again is prevalent in my sample as it is in many other samples, has important implications for choice between equity and debt contracts. So when you think about people's choice of different contracts, as I said, when you think about loss aversion, it shows a higher preference for equity contracts. But when you think about probability weighting and people who overweight small probabilities, they do not like equity contracts. They dislike equity contracts. They much prefer debt contracts. Why is that? Well, somebody who has an inverse S-shaped probability weighting function overweights the very small probability of them making a lot of profit in their business. Even if objectively we don't think that's true, they overweight that probability, and they do not want to end up with that very high level of profits that they would have to share in an equity contract. And they underweight the probability of having lower profits where an equity contract is beneficial. And so this is identifying a demand-side constraint or friction to implementing equity contracts with these small firm owners. And there is literature in finance that has looked at this overweighting and the implications for financial decision-making from households. And again, in the finance literature, they find that many people overweight small probabilities, and such people desire very right-skewed investments. So they desire investments where there's a very small probability, lottery-like investments. And there's also literature which shows that large companies can exploit employees who overweight small probabilities by paying them stock options that are deeply out of the money, because you're essentially selling them deeply out of the money call options, which these people overvalue. So that's a way that firms can exploit individuals who overweight small probabilities. Essentially, I'm showing the flip side to this. If there's a large group of people who overweight small probabilities, they are averse to selling skewness and entering into standard equity contracts. The final thing that I do is I show that a contractual innovation, which is increasingly being used by fintech firms and which I'm looking forward to learning a lot more about from people in this room, can address this constraint. And in particular, I'm thinking about hybrid contracts, contracts that share both debt-like features and equity-like features. So debt-like features in the sense that a certain amount is lent and a certain amount needs to be paid back in nominal terms. But equity-like in the sense that repayments are based on your performance every month or every day, right? So this could be a loan through a point-of-sale system where the repayments are taken every day based on 10% of your sales. And it shares both equity and debt-like features. And individuals who I previously described as having overweighting small probabilities and not liking equity contracts, suddenly they select into these types of contracts because they're essentially capping the upside. And there are similarities here to equity clawbacks in venture capital. I'm reminded of this program Dragon's Den that I used to watch many years ago. Some of you may have watched it, where you have some business person with an idea comes and presents in front of the dragons, tells them that they have this great idea for the next product that they've created, and the business is going to be worth $1 billion next year. And the dragon's just giggling, saying, "That's not going to be worth $1 billion, is it? I mean, I think you're okay, but the business is not going to be worth $1 billion. I'll give you 40,000 to take 20% of your business." And the entrepreneur is horrified. Like, how can you take 40% of my business? I just told you I'm going to be a billionaire next year, right? And the dragon's, again, giggling and saying, "Listen, if you hit some of these performance targets that you think are going to happen and I think are not going to happen, I'll give you back your equity, or I'll give you back a lot of your equity." So these kind of contracts share some of these features. And I think some of these revenue sharing contracts that are increasingly being implemented and we need more work on have some of these features and can address some of these problems that I've mentioned in this paper. So I also validate some of these results and predictions in the actual field experiments from which these participants were drawn. So I'll summarize by just saying that in this paper, I think a little bit about some of the demand-side challenges to implementing equity-like contracts with small firm owners and relating them specifically to risk preferences, and thinking about what kind of contractual innovations can alleviate some of these constraints. And I've done all of this while holding kind of the supply side fixed and just saying there's better data out there, there's potential for tailoring contracts on the supply side. And now I'm very much looking forward to hearing from people who are actually working in this space on what's being done in terms of these revenue sharing contracts, what are the challenges, what kind of innovations are taking place. To quote Paul, what kind of research we need to do. I think there's a presentation later today where we're going to hear about some of the problems with some of these revenue sharing contracts in the sense of like the side selling. You start taxing one type of sales, they move to another platform or another payment system. And so no doubt these are many challenges to these contracts, but hopefully opportunity for keep me very busy with research for the next few years. Thank you.
Jim, can I ask you to hold off for a minute? Because I think, fingers crossed, we are able to go to Tommaso with our second paper.
Hello, everyone. I'm Tommaso Porzio. I'm an associate professor at Columbia Business School. This is a joint project with Emanuele Cornelli, Chicago booth, and then Marcio and Mariana, that they are at the International Finance Corporation, and Chun, who is a PhD student at Stanford. So in this project, we are really motivated by a simple observation. That is essentially that there are two sides of the African continent. One, which is probably, most popularized, I guess, in the academic circle, that is, of course, is still the poorest continent of the world. There is a lot of evidence showing that firms tend to be small, have a hard time growing. Most entrepreneurs are like micro entrepreneurs. But then there is also like another side of Africa, which is essentially, a potential land of opportunity, in particular for like tech-enabled entrepreneurs, or what we call startups in this project. The reason it is that there's a giant market and growing, 1.3 billion people. There is a technology. I guess, in this room, like many of you actually are very well aware of this, so I'm just preaching to the choir a little bit. But our realization is that from an academic perspective, there has been very little kind of focus on this side, on the African continent, that we believe is very important to understand kind of the future growth of the continent. And part of the reason why there has not been much work, it is because there's just no data. And so really what we do in this project, it is essentially we try to develop what we hope is going to be the first comprehensive data set on the startups ecosystem in Africa. And to do that, essentially, we combine new sources of data, essentially, from some internet scraping, and then also a new survey that we do in partnership with the IFC. So what have we learned so far? And I emphasize so far because this is really, an ongoing project. So first, on many dimensions, startups in Africa are just normal startups. It's a booming sector. They tend to be focused on tech. There are some startup hubs. They are kind of fueled by college-educated people. But there are, however, some specific features. In particular, we highlighted like a key role for foreign inputs. So both in terms of foreign capital, so a lot of this startup activity is financed by foreigners, but also in terms of foreign human capital. So a lot of the kind of founders are either foreigners or kind of locals that then spend some time abroad, either to study in university or to like acquire work experience. Last, we kind of realize, and this is like I think very connected to like the previous paper we saw, that essentially there seems to be a large potential for like a local equity financing market to be developed on the continent. And so we do that through an investor audit study. I will tell you a bit more details later, where essentially we kind of highlight that there is a lot of demand from startups from equity, but this equity essentially market is simply not available locally. And that is why they essentially reach out to foreign investors. Okay, so data. So what do we do? Essentially, we have like two samples. Today, I will mainly focus on this established startup sample, and to essentially cover to acquire the data, we simply use the online presence of companies and their founders. So most of the analysis relies on PitchBook, which essentially is like a proprietary data set that covers all, or at least most, VC and PE deals globally. We also do, like in the paper, we do a lot more work to try essentially to see whether the coverage of PitchBook in Africa is good. And to do that, we rely on additional data set, which essentially are Africa specific. And long story short, we see that PitchBook is not too bad. Now on PitchBook, we know a lot of information on startups, on the deals and on the investors, but we do not know much about the founders. So what we do is that then we use LinkedIn data where we can observe essentially characteristics of both the founders, but also the workers of all the startups that are in the PitchBook data set. We also have another data set. I'm not going to talk about this much today. This is essentially data that we collected ourselves by interviewing startups, and we did this in partnership with the IFC. Again, I'm not going to talk about this just for the interest of time, but most of the results which I show with the main data set are robust to our own data. Okay, so let me show you just some facts. This is what we learned about startups in Africa so far. First is a booming sector. So this is just the number of firms. And what we try to do here is compare the kind of startups in Africa with, the growth rate of developed market. Think of it as the United States and Europe and other emerging markets. What we can see is that even though, maybe Africa is not the kind of typical example of a growing continent from the startup perspective, we see actually that there has been a massive increase in the number of firms. The level is still low. There are still, of course, way fewer startups in Africa than in Europe, but the growth rate is remarkable. Then one may wonder, well, but maybe these are all kind of very small companies with very little kind of financing. That's not really the case. So what we see in this figure, we essentially look at the distribution of the typical deal size. And again, we compare startups in the African continent with the one on developed markets and emerging markets. And we see that the median deal size is 1.23 million. Again, not gigantic, but fairly large deals. Definitely not the microcredit or micro entrepreneurs that we are used to think about. We also see that, as kind of expected, most of these companies are in the kind of fintechs and sector, or in general, tech plus something. So of course, most of the continent is still agricultural, and so we see a lot of agri-tech. So try essentially to solve some of the problems of the agricultural kind of traditional markets using new modern technology. We then see that these companies have a very fast growth. So here we see, again, focus on the blue line, which is Africa, the number of employees in our PitchBook companies as a function of their age. And we see that, they're increasing. Again, this is maybe not surprising if you, are aware of the typical startup scene, but it is surprising for the African continent because, most of the work on firms show sluggish growth. And instead, for this particular set of firms, we see actually a lot of economic growth, at least as measured by the number of employees. We then can look at, well, where these companies are. And here, essentially, what we do is in this map, we show these blue dots are essentially the hubs of startups. And they are exactly what you would expect. So most of them are in a few countries. So Nigeria here, Kenya, South Africa, and Egypt are kind of the core centers of economic activities. Also, what is remarkable is that most of the startup activity tend to be close to high-ranked universities, which in this map you see them as a little triangle. So for example, I have a lot of work other work in Kampala, and Kampala here is a big startup hub. And part of it is because there is the Makerere University, which is a very kind of good university with a very kind of large and promising also engineering and tech degrees. Okay, so then I just highlighted startup hubs tend often to be in areas with universities. Well, in fact, this is kind of consistent with the fact that if you look at the characteristics of the founders, they tend to be very highly educated. So what we plot here, this is essentially for every country in our data set, we have on the y-axis the average education of the startup founders. And we see that essentially most of them have a college or even a master's degree, so have studied more than 15 years. We plot this as a function of the country average, overall average education. what you can see is that, even in very low educated countries on average, like Mali or Senegal or Rwanda, if you focus on startups, they are the one with a college degree. And so what is the difference? And this is our right-hand side figure here. It is that in countries with a higher level overall of education, there are just more startups. But the characteristics, the identities of the startup are almost identical, and they are just, the very educated people. All right, so far, what I told you should not be that surprising. Essentially, startups in Africa are just startups. So especially concentrated into hubs, huge role for the tech sector, huge role for talent. But what is special about the African continent? Well, what we show in this graph, it is the share of financing which come from foreign investors. And with foreign, really, we mean outside of the region. Now, if you look at developed markets, there's still quite a bit of kind of international financing. A lot of startups in Europe are financed from the US, for example. However, Africa clearly is an exception in the sense that almost more than 80% on average of financing comes from abroad. And so you may ask, well, but why and from which countries? And what we do in the rest of the paper, essentially, is try to unpack a little bit more this fact and tell you some more information on really where this money come from. So first, let me just show you in terms of different areas. So here, what we show essentially is we see this is all the companies created in Africa. And we see that the largest chunk of the financing comes from North America. This is mainly United States. Another large chunk comes from Europe, a little bit from Africa, very little from China. For us, this was surprising. Of course, China invests a lot on the continent, but it's mainly in terms of infrastructure investment or loans to government. If you look at the startup scene, it's mainly Europeans or Americans essentially that finance them. And of course, there is a role for DFI, Development Financial Institution. You may want to zoom in a little bit more and try to see, okay, let's focus, for example, only on East Africa. Where does East Africa get the money from? And you see again a lot of North America, a lot of Europe, some DFI. What is kind of interesting from this figure is that you see that there is no financial integration across regions. So all the investment which is originated in East Africa, so East African investors mainly invest in East Africa rather than in other parts of the continent. You can then go a little bit more into the weeds, the details, and try to see, to unpack LP from GP. Nothing surprising here. I just want to show you that the DFI have a bigger role as LP in the sense that they contribute a larger chunk of the capital, but sometimes it is deployed through, for example, an American GP. Okay, so lots of money come from abroad. And then the next question is, well, who are these founders of the startups within the African continent? So here we show, focus on this first line here that essentially aggregates the characteristics across the whole continent. What is highlighted in blue, it is the share of people that study abroad or that have experience abroad. Again, this is staggering. More than half of the founders of startups in Africa essentially have some sort of experience abroad. Also, many of them are actually foreigners. So you can look essentially at the share that are, non-Black, and that is almost half of them. Some of these are for example, South Africans of white South Africans, but most of these, and you can see it also looking at, for example, East Africa, are actually foreigners. Side note, the startup activity tend to be male dominated, and that's true throughout the world, and the same in the African continent, not different than other areas. But again, what is really special, it is that this role for kind of foreign input, foreign education, foreign experience as a key component in this startup ecosystem. Again, you can do a little bit more and try to see, okay, where people studied, and you see a picture which is very similar to what I showed you before with the financial flows. Lots of people studied in Europe, lots of people studied in North America. Very few from the rest of the world. And in fact, what we show in the paper, we show that often this financial and human capital cannot flow together. What it means that the typical story is someone like, Platterway, for example, someone that is like, born in, in Lagos, then like, studied in that case, let's say in Canada, studied abroad, have experience abroad, and then go back to Africa, create a startup, but then kind of brought in capitals from the country where the person has some sort of connections or experience. Okay, in the last kind of couple of minutes, I want to show you this survey experiment. So this is essentially an exercise that we did, like, in partnership with the IFC. And the goal here is to say, okay, I show you that there is a lot of foreign input in the startup ecosystem. But why? Is it maybe because startups in Africa really want to access that foreign capital? Maybe because they want to access that foreign expertise. They want to have that seal of approval of getting, financing from Y Combinator. Or maybe, alternatively, it's simply because startups in Africa want equity, and there is not a lot of equity supply within the continent. Now, the way in which we do it, it is essentially through creating some sort of synthetic profile. So essentially, we reach out to startuppers, we show them different profiles of potential investors, which are realistic, but we vary their characteristics. And then once we have all this information that essentially allows us to elicit the preferences of the founder, we just kind of plot them in a figure. Now, without getting into the details of the empirical analysis, what this figure tells us, it is essentially that what startuppers in Africa really want is equity offers. Of course, they want low interest rate if they get debt contract, but really, they want equity offers. So that is the one characteristic essentially that they need. And of course, the equity market within the continent is very limited, and that is probably the reason why they essentially have to reach out to attract foreign capital. Now, in conclusion, what is this project about? Well, there are startups in Africa. We should study them more. And in this particular project, we are trying to put together as much data as possible. Now, why do we think that the facts so far matters for economic development? Again, entrepreneurship in Africa is alive. We just need to focus on those areas where it's present. And so we believe that we should shift a little bit the research from the kind of lethargic small firms to this high growth startup scene. In terms of main takeaway so far, well, we realize that there is this kind of complementarity between the local problems and local expertise, but then the foreign input. Most of the startups are created with foreign financing and with foreign human capital. And last, and this is very related to the previous paper, essentially there seems to be a need for more flexible forms of financing, and in particular potentially for local equity financing within the African continent. Thank you so much, and looking forward to discussion and questions.
So, Jim, maybe you can come and sit down again at this moment, but I think we will try to go straight to Steve Beck, who is the managing partner of Novastar Ventures, a BII partner. Maybe, Steve, you could start by telling us a bit more about Novastar before you give us your reflections.
Thanks, Patty. Can you guys hear me okay? So, yeah, just briefly, thanks for inviting me to the symposium. Really interesting. We launched Novastar's first VC fund in 2014, actually with an anchor investment from BII. So we're grateful to be partnering with BII now for over a decade through 3 funds and several direct co-investments in the startup ecosystem in Africa. We're managing about $263 million, backed 25 companies in East and West Africa, but now some of those have expanded to other emerging markets. Our thesis, really coming off of Tommaso's a good presentation, is we saw the opportunity on the continent, the opportunity to seek to solve the biggest problems for the biggest markets on the continent. People who are underserved, using technology-enabled business models typically. And we had in 2014, frankly, there was no VC asset class on the continent. We raised an $80 million fund in 2014. We were the first institutional VC, I think, on the continent at that time. Total VC funding on the continent, the data is a little bit flaky. Maybe Emmanuel and Tommaso will correct me, but was around $100 million across the whole continent into the tech startup ecosystem at that time. So we set out with a kind of grandiose vision to catalyze a venture asset class, and I'm thankful that we are no longer alone. That rapid growth off of a very low base, we've seen it here on the ground on the continent. And I think it's critical to recognize that we are just getting out of the starting blocks when it comes to VC in Africa. Personally, I'm from the Silicon Valley. It's a venture ecosystem that I know, and it took decades to develop that, often with significant government subsidies from DARPA, from National Science Foundation and others for research technologies and startups. So I think the nascency of the ecosystem is something to keep in mind as we talk about the findings. Tommaso, thank you for prioritizing this field of study. It's wonderful to have serious academic study of the African ecosystem that we've been trying to catalyze for the last decade. I appreciate the detailed analysis of funding and their flows, and I would just want to start by corroborating the observations. I think none of it is very surprising. The venture ecosystems tend to develop around cities. That's true in the West, as well as here on the continent. So Nairobi, Lagos, Cairo, Cape Town are the four large kind of city entrepreneurial hubs. We actually see probably a greater disparity in the ethnicity of venture-backed founders in the Lagos ecosystem than in the Nairobi ecosystem. Nairobi is frankly a much easier place for white foreigners to live, work, and do business than Lagos. That may partly explain that. I want to also just remind people as an early stage investor, as a VC investor, the only thing we typically know about the business plan of the business is that it's wrong. And so we spend a ton of time diligencing the founding team and trying to assess the character, capacity, and ambition of the team, not a sole founder, but a team. And typically the team, we're looking at the founding team, and we're looking at the early hires in the executive positions. Do they have a good understanding of the market that they're seeking to serve? That's absolutely critical. We won't let a dollar go without being confident about that. So I think it's important. That's an important nuance, perhaps, to think about in the data. The paper attributes the dominance, I think, of international capital to white entrepreneurs, to shared language and culture and so on. But I think I would go back to the nascency of the VC and the VC-backed anything on the continent. It is just 10 years old. There were no VC-backed companies before that. The African economy was typically family businesses, wary of taking equity capital, wary of sharing ownership. And that next generation, the people that we're seeing coming back to the continent, who were often educated in the West, as the data, as Tommaso has explained, well, in the West, they were exposed to venture-backed opportunities. They saw it, and they came back, and they instead of coming back into the family business, or instead of coming back and needing to get a job at PwC or Safaricom, they are crazy enough to want to max out their credit cards and start a business to solve problems that they can see around them. And that is only just starting to happen. I think one of the important things maybe for us to think about more is the absence of local sources of risk capital. So local pension funds, for example, have allocated very, very little to venture, very little government funding. Maybe the NSIA in Nigeria shows up here and there. The Africa Development Bank, yes, but their funding a lot of that comes from abroad and focuses more on infrastructure. The local pension funds, though they're long-term investors, right, they're inherently cautious. And because the nascency of the ecosystem is such that it is, there's no VC track record, right? There's no Cambridge Associates benchmarks that a pension fund consultant can look at and say, you should allocate 10% to venture on the continent. We're creating the track record now that won't probably be available for another 5 to 10 years. So I think it's probably unrealistic to expect that we're going to see a lot of local pension fund capital coming into the venture ecosystem. I think the other thing that I'd want to highlight and maybe double underline before I wind up here is that the development impact of VC-backed companies is massive compared to most anything else you see. So our track record alone speaks to this. We backed 25 companies over a decade. Those companies have benefited over 70 million people directly in measurable ways, most often as consumers, but sometimes as suppliers in the value chain of the businesses or employees. 44 million of them are living on roughly $6 a day or less. So they're getting financial inclusion, they're getting access to quality education, quality healthcare, mobility, all the basic goods and services that are needed. Our companies paid nearly $100 million in salaries last year alone and have sequestered or avoided over 11 million metric tons of greenhouse gases. So I suppose the thing that I want to finish with is like, what's the so what here? What can be done to foster a healthy venture ecosystem that helps to drive an equitable, sustainable development path for the continent? And I think the first thing I want to say is patience. We're just at the beginning. I think the founder ethnicity will gradually take care of itself over time. We're starting to see management team members of VC-backed companies coming out and starting their own businesses. We're seeing kind of second-time founders, which is really critical for the ecosystem. We're seeing founders back other founders. That's happened first in Nigeria more than it's happened in Kenya, but that's happening. I would pay attention to the founding teams and the early executive hires, not sole founders. And you could imagine a sort of 2x challenge to incentivize backing local founders. That's being done for backing women entrepreneurs. But I would be careful to look at the capability of the teams as a whole, not sole founders. In terms of local risk factors, I guess, again, coming back to what I said, the history of venture is that it's always depended upon kind of subsidized capital to get going. DARPA, National Science Foundation, et cetera, often funneled through universities. Even, Brin and Page wrote their first algorithm that created Google at Stanford University, but they did it with National Science Foundation money. So I think there's something here about kind of thinking about where is that capital coming to subsidize this? And maybe in essence, the DFIs from Europe and the US and others are providing some of that subsidy. Governments like Malaysia and Rwanda established VC funds with a mandate to develop and back businesses serving the needs of their countries. We haven't seen that on the continent really anywhere. I wonder whether there may be some mileage in that, but I'll stop there and we can open it up to questions or move on. Patty, over to you.
Thank you very much, Steve. And Jim, we've asked you to wait patiently up here until now, so maybe you could start by introducing yourself and Untapped-Global, and then after your remarks, we'll try and get some conversation going in the room.
Yes, Jim Chu, I'm the founder CEO of Untapped-Global, and maybe my first comment is it's very useful and interesting to see that there's a lot of academic research around the things that we observe on the ground, so it's good to get that validation. When Patty mentioned that I should speak with Mohammed, we got on the phone, I listened to his paper research, and I finally said to myself, oh, that's why we do what we do. So it was very insightful to see that. So a little bit of background, before I even explain what we do, I think a little bit of background on how we got there might be interesting. So previously my career was in technology, but I got involved with emerging markets, running essentially an embedded finance company. Well, before I even call it that, we were providing water equipment to entrepreneurs in Haiti and helping them deliver clean water to their communities. And after a lot of trial and error, the method that I found that was most effective was by giving the equipment to the entrepreneurs, tracking exactly what they did and sold with those equipment, and used the sales directly from that equipment to get repaid. So essentially it was a pay-go water model, or digital collateral, the new word I learned today from Paul. Thank you, Paul. And so I was like, wow, this works. And this is great, and this is one of the better ways. I didn't have the word financial inclusion in my vocabulary back then, neither did I have embedded finance, I just knew it worked. So that was great. But when I went out to find additional financing, we were already backed by FMO and IFC. I found that between venture financing and private equity, and commercial debt, there was nothing in between to finance our growth. And when I looked at the terms from the larger commercial funders or debt providers, the terms were ridiculously inappropriate for what we were doing in our countries. And so I said, this is a problem. And again, I'm making a very long timeline collapse into a very short one. But then we started Untapped to essentially provide capital to embedded finance and fintech lenders. And so today, that's what we do. So we look at pure digital lenders, such as those providing merchant cash advances through data for merchants in East Africa, West Africa, South Africa, North Africa, but also, more importantly, and I think more impactfully, embedded finance lenders. So those who have created pay-go models, mostly outside of the solar sector, but mostly not mostly, all for productive use, meaning it has to help the small business make more money so they get repaid. And the three elements of our model that I think coincides with so much with all the research that's been discussed today is, one, there has to be loads of data coming from those businesses, because data is the new, if you will, method for underwriting and understanding what is happening in real time. Second, digital payments. Servicing a loan has always been traditionally very difficult, but with digital payments, we can create integration with payment systems and service loans and collect much more easily and safely. And then third, finally, it's a productive asset. So consumer loans are always tricky because you never know what they're going to do with the money. But if you know, and this I think goes a little bit to the conversation I was having with Mohammed, it's all about incentive alignment. If you're providing the loan or the asset so the entrepreneur can make more money, then your incentives are actually aligned. It isn't, I don't really want to pay you back because why would I pay you back? But rather, oh, okay, I am paying this so that I can keep using it so I can keep making more money. And the more money I make, the higher the returns that my financiers make. So, and that's a critical element in our model as well. We really focus on revenue-based finance because, and I love the reference to Kahneman Tversky, right? Debt is all about downside protection. And so that naturally limits who gets the money. Equity, obviously you're looking at the upside, but there's only certain kinds of companies that fit the venture model. So basically everybody else in between, you don't have an option. But with RBF, or revenue-based finance, and other flexible forms of finance, companies, we can complement venture and complement commercial debt so that can be more flexible financing so that especially digitally driven or technically driven lenders, embedded finance lenders, can grow. So that's essentially our model. A lot more comments on the things people said, but the biggest one I think that was, I think, validated in Mohammed's research that I really liked was the importance of incentive alignment. So many of our financing models, the incentives aren't really that aligned, or it leads to bad incentives. I think there was an earlier comment about, is it a fault of investors for pushing these companies to grow too fast? The answer is simple, yes, but wait, it's not because the investors are stupid or they're bad, because the 2%, 20% carry model focuses on hyperscale growth and pushes them to push entrepreneurs to grow faster than they may need to, right? So the better question is, what is the right structure of the financing? And RBF isn't the only answer or the best answer per se, but what is the best form of financing to create the right incentives for fintechs or embedded finance lenders to grow responsibly? And so that's part of what we try to do in our model. We use the data to assess the risk of each of the fintechs. So I think it was mentioned before, I think it was talked about during the PayGo Solar session, right? You have this great product, your venture investors push you harder and harder and harder to sell, your quality of sales go down. Well, what we try to do in our model is we actually monitor, we don't call it quality of sale, it's just the risk of the portfolio, through the metrics, through the API integration that we have with each of these digital lenders, so that we can ensure that the risk level that they're taking stays the same as they continue to grow. So yeah, sure, let's push them hard to grow, but at the same time, let's ensure they're not acting irresponsibly or doing things in a way that actually undercuts their business long term. So that's generally what we do. We call ourselves a fintech and embedded finance aggregator. Why? Because number one, we're providing that non-dilutive finance to the fintechs, embedded finance lenders. But more importantly, we're aggregating the data and aggregating the revenue streams from these different digital lenders so that we address a major problem in the African marketplace, which is fragmentation. There's only so many companies that are large enough to be interesting to international investors. So what we try to do is aggregate the chunky middle of the tail so that more of the highly impactful very successful yet not quite big enough companies can get access to international capital.
This idea of something in between VC and debt is very interesting, and I think after lunch we're going to hear in the policy panel from a couple of businesses that are doing, I might be about to misuse jargon here, is it mezzanine? You know, the stuff that has characteristics of debt and equity. But I wanted to, we're going to open to the floor, but there was something I wanted to ask Tommaso and Steve, which was, it was something that came out of the paper which puzzled me. It was that the startups in Africa said that they weren't particularly interested in non-financial kind of interventions by their investors. They just wanted the equity financing. But at the same time, they seem to place a lot of importance on local knowledge, which seemed like a little bit of a contradiction to me, because I would have thought local knowledge was a non-financial input. Tommaso, can you say a little bit more about what you think is going on there? And maybe Steve, what's your experience of the extent to which your portfolio companies really value the advice and non-financial inputs that you are able to give them?
Yes, so let me begin. So first of all, just to kind of recap the results, because I went very briefly through them. Essentially, we are able to vary different characteristics of an investor, and indeed, you're absolutely right that some of them don't seem to matter much, and among those ones are any sort of non-financial help. We were frankly surprised as well. So, in all honesty, we were not expecting that result. There are two possibilities. One is that maybe they do care about it, but it's just swamped essentially by the preference for equity. So recall that everything here is relative. And so in practice, maybe they do prefer it, they do care about any sort of non-financial help, but just not much. And so then whether contact is equity or debt kind of dominates everything else. The other possibility, which I also think is important, is that remember that we are asking, we are eliciting the preferences of those people that are already in the startup ecosystem. And so maybe they already feel like, they have access to this type of non-financial help because they're part of accelerators, they're part of a community, they already have international connections. Many of them have studied abroad. So maybe given where they are, they don't need that additional help. But that doesn't mean that those type of non-financial, essentially, kind of inputs are not useful. It means that they're not useful for that specific sample that we are studying. But I would love to hear the thoughts of Steve. And by the way, let me actually just take a second to say, Steve, thank you so much for the very insightful comments and discussion.
No, my pleasure. Look, I think, first of all, the first thing to say is that every venture investor anywhere in the world is inclined to overstate their ability to add value beyond the financial capital. The reality is, as a venture investor, we're backing, if we're doing our job right, it really matters the selection. Like, we invest in less than 1% of the businesses that we actually stop and evaluate and look at. And we're selecting really for primarily for the founding team. And then are they, is their kind of founding team market fit, if I can put it that way? And are they addressing a big enough problem in a big enough market where this business could get to scale with some innovation that we understand, that we have conviction about? And so we're really helping them. We're minority investors. We're helping them build their business. And we all benefit if the business gets to scale. Having said that, I think it is true to say that those founding teams often come with their very high capacity. They've been selected for that. They come with a better knowledge of the market that they're serving than we have. But what we do have is we have the benefit of seeing lots and lots of different businesses. And so there is knowledge that they value. There's a kind of pattern recognition that they tend to value. I think what they value more is relationship capital. So the networks that we have, the signal that we can send to other investors when they need to scale, or to debt providers when they need debt, and importantly, to access talent, which is still scarce relative to the need or the opportunity here. So we spend a lot of time helping our companies find good people and get them in place. And then the other thing, frankly, is to help them be ready to access bigger ticket capital. So if they do get to scale and they're going to have to raise debt, direct debt from a DFI, then all the environmental, social, governance factors have to be in place. And a lot of great entrepreneurs haven't thought about that, and they need help with that. So those are some ways. I mean, we've catalyzed about $6 for every dollar we've invested in our companies. So there is a kind of value there. There's that signaling effect that happens, and the ability to help them access capital. But look, I also agree. I think most entrepreneurs who are successful, they just want your money, and then they're going to do great things with it.
Thanks for the presentation. It's really interesting. My question's about margins of businesses. So generally, these like instruments will be looking for a bigger return than debt, right? Because it's more risky. Like what we see in our lending to SMEs in Africa is that debt's already really expensive. A lot of it because it's local currency. So maybe 25% interest rates, and businesses just don't have the margins to pay that. So I was wondering what you're seeing, if you're looking for instruments like this with more upside, do you think that businesses have the margin to be able to afford to pay that?
Go, Jim.
So I can address that. I mean, obviously that's core to our issue. So as I mentioned, debt has limited upside, right? It's debt is capped in terms of what the return can be because it's debt. And so therefore, everyone looks at the downside protection for a lot of the Kahneman-Tversky reasons that I think you mentioned and others, loss aversion and so on. So, and equity, obviously, it has the promise of significant upside through the higher multiples, but especially in the African context, exits can be difficult, and realizing that return can be also difficult. So one of the reasons we chose a revenue-based finance model was that we were able to capture some of the upside because it is equity-like in the sense that we're taking a tremendous amount of risk, if you will. Yet we're not waiting for the exit to get the return, right? We're taking a percentage of the revenue straight off the top directly from the digital payment systems. And so we're able to actually achieve 20% plus IRR in USD through this model. Now, I always tell the partners that we work with, we shouldn't be your only source of capital, right? You should be getting bank debt. You should be using equity to prove out your model. So don't use us to prove out your model. It's got to be proven already. But you also shouldn't be relying solely on debt to grow because by definition, debt is limited. Most people are over-collateralizing and have reserve ratios that don't allow you to grow to the extent you want. So if we can complement equity and complement the debt, then we provide, therefore, a on-demand source of capital that is worth the higher, quote-unquote, cost of capital because it is that last bit of capital that you need to keep on growing and realize return. At the end of the day, I have to confess, I'm an economist as well, but way back in the early 90s. And I always believe in the microeconomic theory that you produce up until marginal cost equals marginal profit. Right? So you should be producing, in fact, you should be borrowing to an extent up until your margins are zero at a marginal level. Right? And that's essentially what we're saying to our partners, and that's what we do as well, which is, yes, keep on growing responsibly, of course, up until you're making no money on the marginal dollar that you're deploying. I don't know if I answered your question or not.
I've had time to digest some online questions, so do you mind if I just ask a couple before we go to the room? So one question is about reconciling the desire for equity with the aversion to diluting control. So it was definitely one of the things, you didn't get to mention it, Tommaso, but I saw that don't want a board seat over on the left of one of your graphs. Now, that could be something for, I guess, Steve, Tommaso to talk about. I think this might also be, I guess, for Steve, because it's about how you how you look at financial. I suppose it's financial and non-financial. You know, because you reference like your kind of social mission, your desire to solve problems. And when you're looking at a business, how are you weighing, like, is there some sort of trade-off, or do you kind of have to weigh these things differently, like the social impact and the financial returns? And the question there is actually, how would you advise founders to present these things to you? I think there was that someone was looking for that sort of advice. And then we have a question which I don't even know whether I should say because it's such a big one. It's someone who is written in to say, you know, looking at the profile of these startups, let's for the sake of kind of brevity say that it's the elites. You know, these are the elites of society that are getting this money. How is that compatible with what DFIs are supposed to be doing, reducing poverty? Now, I feel like I've spent my career at BII evidently ineffectively trying to explain that. If the person who wrote that question didn't hear me say at the beginning that we have a paper out about why we invest in private equity funds, hopefully there will be some answers there. There's another paper called How Growth Reduces Poverty, which might be helpful too. But it would be interesting to hear like what people think about the fact that you know, how do these larger firms run by the wealthier, better educated people, are they actually really important in the poverty reduction story? Steve, I feel like a lot of those are landing at your door. Do you want to take some of them?
Yikes. Thanks a lot, Patty. First of all, I would want to start by saying most firms should not take venture capital, right? It's a minority asset class, and it's got very peculiar characteristics, and therefore, you know, it's not going to be a kind of the mainstay. I love what Jim's doing, like that. I think the sort of incentive-based finance or revenue-based payout is going to address many more companies than a kind of venture model will do. So you know, obviously I'm in the venture business, I'm in the VC business, but you know, I just want to say that most people shouldn't take venture capital, right? And should only take it if really the characteristics line up. So I think that's the first thing to say. I've forgotten, Patty, what all the questions are. There was one I think that was aimed directly at me, which was that kind of striking the balance between financial, climate, social impact. We founded Novastar with, I guess, an impact motivation, but we founded it as a commercial VC. So, and we felt like we didn't have to twist ourselves out of shape, that particularly on the continent, if we are addressing the biggest problems in the biggest markets, which VC has to do, because you're going to have failures, so the winners have to succeed at a very large scale. And they're going to do that by solving really big pain points for lots and lots of people. And the biggest markets on the continent tend to be the underserved, lower income households. And so we felt like we didn't have to sacrifice our commercial sensibility to get impact. So we essentially, from the beginning, each of our funds has had a social, or with our third fund, a social and environmental impact screen. We screen at the front end, and to make it simple, we're just looking for a clear positive correlation between the kind of financial, social, and environmental impact that grows. So is that social and environmental benefits going to grow as a natural consequence of the commercial growth of the business? And if we see that those are somehow at odds, we can't invest, we won't invest. It's a formal screen. And then we track all of them. We obviously have to track the financial operational results of the businesses, but we report quarterly to our LPs on the social and environmental value that those companies are creating as well. And so, you know, that's where it fits in our thesis. When we look at investments, we look at it that way. So we're looking, is this business satisfy that screen? And then once we've invested, it's all about building a great business. So then it becomes axiomatic, right? Then it's just, let's just build a great business, because the commercial growth should drive scaled impact, either social or environmental, or both.
Does anybody want to quickly jump on let's say the control dilution point? Like, people want equity, but they don't necessarily want the.
Let me just say one very quick answer to that. that is not surprising in the sense that founders do not want to, lose control. Frankly, we were actually kind of adding, we add this trade-off to try to understand whether our startuppers are essentially financially literate and financially savvy. Because again, there is a lot of this idea, and there is actually a lot of evidence that there is a lack of financial literacy on the continent. And instead, we find that once we look at this specific group, it's exactly the opposite. They are very well aware that getting equity implies losing control. And at the same time, for example, we learned that if you look at startups that are generating already positive revenues, they're way less likely to want equity, and they're more likely to want debt. So these were more some type of checks to essentially see that people were as financially literate as typical startuppers and not as a typical kind of small family firm. The other very quick thing which I want to mention, I think is important to ask ourselves whether we care about startups and VC financing for the overall growth of the continent. And I think the answer is yes, because even if those founders tend to be part of the elite, and that is absolutely correct, especially many are the ones that have the possibility to kind of study abroad, so they're really 1% among the elite. I do think that the benefits are widespread. And there is a lot of evidence in the kind of US context showing that most of the innovation is driven by kind of VC and startups. And of course, innovation and technological improvement benefits everyone. And on the continent, there is one example which is very salient, that is a payment system. Of course, payment systems benefit the founders of the company, but benefit also everyone. You now see those small farmers in rural Kenya essentially being able to do better transactions to sell tomatoes on the local market through payment systems that have been developed with foreign financing.
Thanks so much. My name is Mayada El-Zagbi, and I'm the managing director of KIT. And I was curious because, Mohammed, you and I have spoken in the past, and I felt that the segment that you refer to in your demand work is very, very different than the startup population. And yet there was still interest in equity. And I just wanted to know, or equity-like structures. And I'm just curious, how do we solve that demand challenge? And because it doesn't seem like the VC model is the way to do that, but I'm just curious what you think about that and what others think about serving not the startups, not the elites, which is, I think, the population you're dealing with.
Thanks. Can we take one more question before you respond, and then we'll... Alice, do you have a question?
I do. Thank you. And mine was around the 765 companies that you're looking at, Mohammed, around whether you distinguished between different sectors at all around the appetite for risk aversion and loss aversion within different sectors, or whether that's a future area for interesting research.
So thank you, Mahad. So I think, definitely the population that I was looking at was more on the micro enterprise, small firm, maybe 1-2 employees max side. And I think it's consistent with what Steve said, that these are not people for venture financing ever. And this is more people that should be aspiring to what Jim's doing, which is non-dilutive, equity-like, revenue sharing type of financing structures. And so it may be that 1 or 2% of these firms could one day be suitable for this, but it's definitely thinking about that missing middle, if you like, of financing that has features of both of these things. And I think that's an important space for us to kind of work on developing both practitioners and academics. So this is, the sample from Kenya was we were working within the supply chain of a large multinational corporation, working with its distributors. So this is one very particular sector, specific sector, which was people who are distributing product for a large multinational, and we identified a productive asset that could help improve their profit. So it was, again, a quite unique setting in that we tried to look for a space where there were small businesses which had a clear investment need, a clear asset even in this case, and then providing the financing for that asset. And the other sample was Pakistan. Again, it was a similar case of people who had come to us and said, this is the fixed asset that we need to expand our business and get profits. The current microfinance business model only provides us with this amount of borrowing. We need 4 or 5 times as much as the highest amount that the microfinance institution would lend to us to get access to that financing. So the title, the first sentence of the introduction of our paper is microfinance to micro? And so for many it is, right? And so I think that links to the two questions.
Can I jump in on this question really quickly as well and tie it into a comment that was made earlier? So our primary target and who we want to serve as a motivation is that micro entrepreneur, if you will, the part of the market that's not being served by venture capital or commercial debt. But it's interesting because, and going back to the earlier comment about elites and venture, we rely heavily on venture because it's the venture investors that are funding early these different models that are usually technology driven that then create a platform to be able to finance these micro entrepreneurs. So an embedded finance offering such as an electric motorcycle, they're going to get their first dollars from venture. Or a payment system that does lending to small merchants for inventory financing using data, that's going to be financed by venture. So I don't think you can say we don't need venture. Right. What we're saying is that all these tools need to come together in order to solve those markets. And to Steve's point, you know, if we're relying on venture dollars to finance the small entrepreneurs, and that's the only thing we're doing, then there's a missing hole there. So we need to be able to complement it. But the venture is necessary.
That's a great point. I was smiling. You know, Chris and I are working on an electrical vehicle financing project, which I hope it turns into a project and it's not just in the history books as an attempted project. But this is something where it's kind of like small scale, couple of $1,000s maybe for an electrical vehicle, but it very much heavily relies on what's happening in terms of venture financing, the supply of these vehicles into the country. And so it's all interlinked really, right? And
I'm sorry, I want to wrap up. Sorry. So can we just thank all our speakers? I think it's been really very interesting. Thank you very much.